Weak growth, subdued bank lending and rising unemployment. That's what the Eurozone has in store for next year. Standard Chartered says it's a combination that'll push Europe into recession in 2012. So much so, it's revised down growth forecasts and predicts a contraction up to 1.5%. With us is Standard Chartered economist Thomas Costerg. You suggest recession in Europe is going to be much worse than you predicted just a few months ago. Why?
In fact, there's a triple shock. There's a shock to confidence, because people will spend less, businesses will invest less. There's a shock to the banking sector, with many banks having problems on the funding side, having problems on their sovereign debt holdings. And you have another shock, which is a shock to the fiscal budgets. There is austerity across the board, across the region. And so all these three shocks mean basically a contraction in GDP next year.
Well, you've mentioned those tough austerity budgets in place around many countries in Europe. Does that mean that a lot of countries will actually meet or miss those 2012 deficit targets?
That's a very good question. And in fact, what we're seeing is that there is a very weak growth in 2012. This puts tax collection targets at risk. And this means basically that many countries will miss their targets. And probably that's why rating agencies are also on the alert, and they're saying, well, wait a minute, your targets are at risk.
Rating agencies also have been out in force saying that they don't see any sort of comprehensive solution anytime soon to the European debt crisis. We've got finance ministers meeting today to talk about another 200 billion euros to the IMF. Does this help at all, or actually is it just being written off?
Well, you have two things. In fact, there's probably a paradigm shift from rating agencies, which is quite worrying. They are questioning the underlying assumptions behind the euro area. The underlying assumptions are that in case of a stress, some countries would help. I mean, they would help each other. And the ECB would take a more proactive stance. And this is not happening now.
Clarify your position on the United Kingdom for me, if you would. You say a contraction of 1.3% predicted for the UK. Is that for the whole year?
Yes, that's true. 1.3% contraction next year. You have two things in the UK, in fact. First, you have weak underlying activity in the UK. That's due to the austerity program, ongoing deleveraging, still a weak housing market. And on top of that, you have growing worries coming from Europe, basically. And so if you add up those two problems, basically, you have this contraction.
And when you look at France's economy and you compare it to Britain's, and you had that spat that we had last week about, who deserves to be downgraded first, essentially, do you see great differences between the French and British? Do you think both of them should be downgraded if you were a rater?
I'm just saying that the average debt-to-GDP ratio for AAA rated countries is around 60%. For the UK and France, this will rise above 90%. I'm just saying this.
You're just saying that. OK, I won't push you any further on that. What's the next symptom, Thomas, of contagion that we should be looking for as we go into 2012?
Well, there's really a problem. I mean, the problem in Europe is a sovereign problem. And this has not been dealt with. Let's see with this call this afternoon if this has been dealt with. But we still need more from policymakers, from the ECB on this sovereign issue.
But what? What would you like to see? I mean, you've got. Do you think the ECB will actually be forced into a corner, have its back to the wall, and actually will take a look and come February, March next year and say, OK, guys, that's it. You know, we said we wouldn't do any more bond purchases. We got her to save the euro. Do you think that is a credible scenario?
Well, I'll tell you something. In fact, I think there is no other option that the ECB just gearing up on bond purchases and just, sending a more aggressive signal to the market, and that would really help. And I mean, I think there is no other choice.
We know there's a big problem with liquidity in the system. That's something that the ECB has been focusing on. Do you think it's right to be focusing on that?
Well, as I said, there's a banking problem and there's a sovereign problem. The ECB has done a lot for the banking problem. Basically, they are inundating the banks with liquidity, they are cutting reserve requirements, they are buying covered bonds, so they are doing a lot for the banking sector. But we have an issue that is the sovereign as an issue, and this is, we still have no answers for that.
Thomas Costerg, economist at Standard Chartered Bank, thank you very much indeed.